Welcome everyone, Happy New Year. We're back at Mere Finance after a small pause in our videos. And today we're going to talk about credit cards. Seems like the government, via an executive order, has issued a 10% interest rate cap. So we're going to see what the effects are on the credit market and also on the consumers. But don't forget to subscribe. So the old capitalism trick. When Donald Trump comes to power and he starts putting price ceilings on the credit markets, then everyone says like, oh, look at that guy. He's such a capitalistic guy. Well, Donald Trump's actually not that capitalistic because he's putting an interest rate cap aligns to what Senator Bernie Sanders in February of 2025 did. So basically it's the same, just repeating a social aspect into the credit markets, advocating for a release of debt burden on the American people. Well, let's see what actually this entails. So how do credit cards companies make money? So the big players in the market, Visa, MasterCard, American Express, and Discovery, they don't really issue the cards themselves. They use the banks to issue the credit cards. And what their money comes from is from service fees. Basically, they charge the issuing banks, your JP Morgan, your Citibank, your Barclays, your Charles Schwab, in order to service those credit card payments, because they have the whole network payment that allows them to charge at every single consumer, every single business, your respective charge. You also have data processing fees coming from there. These are fees from authorizing, clearing, and settling transactions, plus the access to the network and the maintenance. And you also have your international and cross-border transaction fee. So this is where they make money on currency exchange when a person goes into another country and spends there. So basically making sure that that person is allowed to use that credit card in another country that has a fee, and also the credit card. And the current one that is growing is the value-added services, which is the fraud prevention or tokenization, consulting, risk management, and data analytics. Because they have so many payments coming, then these credit card companies are able to provide not only the fraud aspect, but also the data analytics or where the consumer is moving. So this is the revenue breakdown from the big four players. Visa, almost $5 billion in revenue. American Express, 6.6. MasterCard, 2.8. Discovery, 1.7. Visa and Visa has a different component because most of it comes from transaction and network fees. It has probably the biggest one across the world. Also, MasterCard has it, but they use mostly the service value to come up with those revenues. And the interesting part is Visa has big licensing and big EAAs, what we mentioned, the value-added services about fraud and prevention and data analytics. They're really tapping there. American Express, also a lot of transaction network fees, 59%, but they're big in the way of just creating a lot of like cliche. So they do an integrated issuer and network. So they're premium focused. They're premium focused in the sense that they try to charge higher for credit card usage because they provide a lot of good benefits. And also they have a lending on revolving balances. That's 41% of their business. Same with Discovery. Now this is also interesting. The credit card interest rates based on your FICO score. So anything that is under 580 is considered subprime or poor. Usually the APR, the annualized percentage rate, is around from 28 to 36%. The midpoint is 32. Fair, the midpoint is 26. Good, which is where most people land, is at 24%. 740 to 799, which is very good, is at 20%. And excellent, 800 and plus, is 18%. But the median across the whole consumer section is 22.5, which seems to be high, but in other countries there is sometimes 29% to 55. So what Trump proposes, basically a ceiling at 10%. We already saw that the median is 22%. Not even the excellent credit card scores get charged 10%. They get charged within the teens range. So 10% really could create an excess of shortage. So in this graph, we see the interest rates on the x-axis and the capital provided for lending on the y-axis, and it really shows that at the 22% interest rate, that's where we see the equilibrium, and at 10%, will there be an excess of shortage in capital? Well, let's explore, let's see. Because this is basic economics. When you have a price ceiling, you actually get an excess of shortage. So these are the actions. Credit card, net, and operating profit margins, they will survive. They have plenty of margins, especially because most of their revenue come from their network payments, not really from lending money. It's most from the ability to use the network to pay. However, they will have harder credit score qualifications, and we are going to expand on this topic. Probably they will also start applying annual fees to every single card, so no more free credit cards. They'll probably raise late payment fees to capture that capital faster. At 10% is not very profitable for them to lend that amount of money, so they need to raise the late payment fees to get more capital. If they lose profitability, they'll probably make it up in market share. So they won't close accounts, but they will probably open up to other consumers with lower fees or some sort of promotions and more incentives. But at the same time, they'll probably do smaller cashbacks and points, because they're basically financing those cashback and points with the people. When they are able to charge really high interest rates, they make that, because people that pay on time usually are the ones that receive the cashback points. But in order for the servicer to provide those cashbacks, they need people to pay higher interest on the other side. So probably those cashback and points will decrease. Now, the arguments are, yes, harder credit score qualifications, because at 10% it doesn't become very profitable or appealing to lend money. But no, we think that margins are high to offset cost of providing small short-term loans to high-risk borrowers. We know it requires origination, servicing defaults, and compliance. I think the margins are there. I don't think it will drive lenders out of the market in the way everyone is saying, but it might create a massive credit vacuum for subprime borrowers, because companies are not going to lend money that easily if you can only charge 10%, even if your credit score is trash. So yes, probably there will be an increase in payday lenders, in loan sharks, in car title lenders, in pawn shops, or informal friends and family, which actually bring the higher cost of lending, sometimes 300 to 1,000% APR equivalent, and far worse terms. And also the collections will increase. So at the end of the day, the conclusion is there is some evidence. Rhode Island, for example, did some state proposal with very low interest rates, 10 to 17% in some jurisdictions, and it indeed decreased the credit availability for those regions. Now, moderate caps at 36% in some states have reduced the worst abuses while preserving some access, because we do agree usury is not a way of just making sure people get ripped off. Because as we all know, so credit cards used to charge 54%, and people, if in order to get to the end of the month need to go there, then it just creates a system of debt and debt and debt. So a lot of the proponents claim that a 10% cap rate will force efficiency, not elimination, since current margins are thick enough, which is, it matches our view across FICO tiers to cover risk and losses. So in the sense, we think 10% won't affect Visa, MasterCard, American Express, but it might affect other access to credits, and the credit score is going to be very important to lend money. So I think those companies will be fine. people, not so much. And it's just funny to see that apparently one of the most entrepreneurships and one of the best businessmen in history of the United States actually proposes a socialist policy. So just food for thought. So thank you for watching. Let us know what you think, and we welcome you for the next episode here in Near Finance.